welcome to Friends That Invest, the podcast that feels like a voice note from your favorite finance friend. I'm your host, Sim Kaur. I am wildly passionate about investing education, and every Tuesday I'll be breaking down investing and personal finance tips so that you can stay confident and informed. Today I'm going to be breaking down all the investment mistakes that I made in my first year of investing, because there are plenty, and it is going to be kind of scary to go through them, but also kind of fun going down memory lane and thinking about what kind of person I was and how fearful I was, and yet, what things look like now where investing is not scary anymore and I feel very comfortable and I enjoy doing it and it's fun, but that was obviously not always the case. And if you can learn from my mistakes, then this will be a good episode that hopefully you can take a lot of good nuggets away from. Now, the first mistake that I made when I started investing is the investments that I had bought in my first year. The investments that had the least amount of shares that I had bought, those investments went up the most. Let me say that again. So I bought a couple of different investments in my first year. I bought a couple of individual companies, I bought some index funds, and I bought a little bit of a particular index fund called VT, which is just a total world index. And I didn't spend a lot of money on it. I think I bought less than $100 worth. I was like, I've read that this is good to have, the Bogglehead method, have some international funds, along with your main S&P 500 funds and your bond fund and some individual companies. And I put less than $100 into it. And at the end of that year, I didn't even realize until when I was making this episode and I went back and looked at my first year, that was actually the investments that had returned the highest amount. And yet that was the one that I had put the least amount of money into. And it just goes to show you truly cannot predict what is going to be a good investment. At the start of the year, if I had gone, okay, I'm going to buy these shares, I assume this one will do well. I assume this one will give me 10%. This one will maybe give me 15%. This one 4%. You can assume all you want, but you cannot predict the market. You can assume that on average, the market historically has returned about 7%, but beyond that, it can return 5% that year. It can return negative 10% that year. It can return 20% that year. I mean, in 2025, it's returned about 17%. And so it was a good lesson for me, because when you start investing, I reckon you just think, everyone knows more than me. There must be more out there. I'm sure I'm missing something. There's got to be more to it than this. And in all honesty, there's not. You're not looking at and investing and thinking, oh my God, it's quite simple. Am I missing something? You're not doing that because you're dumb and you're missing something. You're having those thoughts because it's actually true. Investing is not hard. You just invest in broad market funds, a few individual companies if you want, but that's more of a satellite portfolio. Your core portfolio is these funds. And you just kind of ride them out and trying to pick and choose the winners, as I saw in my first year, the one that I spent the least amount of money on had the biggest return. And had I known that, I would have put a lot more money into it, more than $100. But it kind of just goes to show, you cannot stock pick consistently, and you cannot stock pick well. The second mistake I made in my first year investing is I instantly sold my first shares. I have shared the story before, so I do feel like a broken record sharing this, but there's a lot of people that have never heard it. 2, there's a lot of new besties. And 3, it's such an important story that if you have heard it, it's a good reminder for myself as well. But essentially what happened is just imagine this young Sim is sitting on her laptop. She's buying her first shares. She's so excited. She has $300 or $500, and she put some of it into Amazon. That was one of the first shares I'd bought. I was like, guys, it's going to be big? Online shopping. And so I just thought I was such a genius for that. And I bought these Amazon shares, and instantly, because the share market was live when I bought those shares, I bought them and instantly they went down. They went into the red. It was let's say I'd bought like $100 worth. It was now like $94 worth. And I was like, oh my God, like, why would the investing universe hurt me like this? I was so upset and I freaked out. Like, that's a lot of money, especially when you first start. I then sold those shares instantly. And I was like, I don't want to lose any more money. I'm out of this. And then I was like, Sim, what did Warren Buffett say? Like, what did you learn when you started investing? Buy and hold. And your dumbass has sold within like the first couple of minutes. So what did I do? I then went back and rebought those shares. And so I had bought Amazon stocks, sold Amazon stocks, and then rebought them within like the same 30 minutes. Like whoever my brokerage was at the time, whoever was like sending these trades was probably like, this girl is like having an aneurysm. Like, what is going on? Like, please, someone go help her. Clearly a newbie. And what was annoying about that is back then when I was doing that, now when you trade, it's usually free or it's a very low cost. But when I was trading back then, like buying or selling a share is called a trade. That was $8 a share to trade. So bought them, $8. Then I sold them, another $8 in fees, and then I rebought them. So in half an hour, I'd spent $24. And back then that was a lot of money. That was like a couple of hours of me working in like my part-time job during university. Like, it was not a good time, but it did teach me a good lesson, which is that I clearly cannot handle the ups and downs. At the time, I was like, I can't handle the ups and downs of individual shares. Like, these things are moving up and down way too much. And you know that saying, like, if you can't handle the heat, get out of the kitchen. That was just me to myself in my bedroom. I was like, if you can't handle the heat, Sim, get out of the kitchen. Like, don't invest in individual companies. Don't invest in too many of them, at least. You can't handle, like, I don't know, holding 25 individual companies and that being your entire portfolio. You are definitely more suited for investing in funds. And so in a way, horrible experience, wasted a lot of money, but a good lesson to learn. And over time, I came across a study that I always love to share, which was by Standards & Poor's. It was done in 2017, and they found that most professional fund managers can't beat the market over a 15-year time horizon. Like, I think it was like 92 to 96% of professional fund managers can't beat the market over time. And so that also taught me the exact same lesson. Like, I can try and pick individual companies if I want to, but the likelihood of me beating the market is so low that I'd rather just have most of my investments at the market, tracking the market. Like, if the market goes up 5% that year, I just want my investments to go up 5%. If the market drops, 2% that year, I just want my investments to drop 2%. That's going to be my core portfolio. And then I'll have the satellite portfolio that is more for fun money, investing for things that, can go up and down, but that cannot be my main investments, because if I am freaking out over losing $8 of one Amazon stock, like, I just know that that's not for me. And I want to be able to invest in a way that I can sleep easier at night. Like, isn't the whole point of investing making money? Like, I don't want to be losing it. That was essentially like my thought process. And so that was a bit of a mistake. But again, I think being just like an optimistic person, I always try and find a silver lining in each story. I'm like, what was the lesson here? I remember like having some horrible stuff happen, and I was like talking to my therapist about it, and she was like, if there could be a lesson learnt here, what would that lesson be? And I just remember thinking, I don't really want to hear that right now. I'm just like grieving. But in hindsight, I like the idea of taking a bad thing and then being like, okay, what was the lesson learned here? And in this case, the lesson was, Sim, you can't handle too many individual stocks. Let's go to index fund investing. That is your safe space. The third investment mistake I made in my first year of investing is I did not invest any money into bonds. And at the time, I thought that was a good strategy. I was like, I'm young, like I'm like a teenager. I don't need to be having my money in bonds. Like, bonds are for old people. And I kind of had this perspective of, okay, I know the bogglehead theory. You put, some of your money in an index fund that invests in the US market, some of your money in an international fund like VT, and then you put some of your money into a bond fund, and those are your three funds, and that makes up, a simple investment portfolio. And yet at that time, it was a very do as I say, not as I do situation. I think I still feel that way even now. I don't, at the point of this recording, it's changed. At the end of last year, I had bonds, and then I ended up selling them, and I don't have bonds now at the start of 2025. And so it continues to change for me. But back in my first year of starting, I just didn't see the need for it. And I would put it down to a little bit of naivety. And I would actually also argue that I still continue to make this mistake. This is not a mistake I have learned from. I can't commit to having a portfolio with bonds because they just seem like they're not moving, which makes sense. They're not meant to. They're just meant to give you a 2 to 3% return each year. But I think because the last 5 or so years have had such high interest rates, online saving accounts have done so well that you can get a 3, 4, 5% return on just having your money in a high yield savings account. And so I haven't really seen personally the need to put my money in bonds when I can just keep them in these high yield savings accounts. Now interest rates are starting to fluctuate more. They're starting to come down. And so maybe there is more of a need for bonds. And I tried guys. I tried to make that move at the end of last year, and I just couldn't do it. And I honestly find myself happier to keep my money in cash in these high savings accounts than in bonds. When I have spoken to my smarter financial friends, one of them is an ex-financial advisor, and they were sharing how they're on the older end of millennial, if I can say that. And they were sharing how they just don't want to invest only in 100% stock portfolio. They were like, that is very aggressive. It's way too much growth. And they've actually seen the downsides of, the GFC and seeing markets drop for a long period of time. And so there is definitely a need to have bonds when those kind of market dips occur. And if you are listening and you're like, I don't know how much I should have of my portfolio in bonds. I've shared this in the past, but I love the idea of just using your age. I'm 29. Let's just round it up to 30 at this point. I'm 30 almost. And you take your age, and that is how much money you should have in bonds. So if you are 25, then round down to 20, and 20% of your portfolio should be in bonds and 80% in stocks and funds. In my case, if I'm 30 or almost 30, then 30% of my portfolio should be in bonds and 70% in stocks. And I just still feel like 30% bonds of my entire portfolio seems like it's way too much. But I don't think it would hurt to have 5 or 10% in bonds. And so if the market does have a huge dip for a long period of time and I haven't invested in bonds, that could be a bit of a scary situation. But because I keep such a large percentage in other investments, I say large percentage, a 5% in other high yield savings accounts, not investment accounts, then I don't feel too stressed about it. But again, a mistake that I'm continuing to make, and definitely one of those do as I say, not as I do options. Now, moving on to mistake number 4, this was something that I just laugh at because I had such good intentions. But one of my mistakes in my first year investing is that a company was IPOing, and I was like, oh my God, I am just so excited. Clearly no one else knows about this IPO. I'm so smart. Obviously I was not smart. Obviously everyone knew about it. Obviously it was a tech company. And I bought this IPO stock because I thought, well, it's only going to go up from here, right? When you look at the total graph of what Apple stock looks like or Google Alphabet stock looks like, you see it was so cheap in the 1990s or the 1980s. And then it goes up significantly in the 2000s. And I was like, well, if I buy the stock now, that will do the same thing over 10, 20, 30 years. Bought the stock, went down instantly. It dropped like 15%. It was the worst performing stock I had in my portfolio that year, and it didn't recover. And I bought $200 worth of it. So again, in the grand scheme of things, not a lot of money, but oh my God, like when you're in your first year of investing and when you're a university student, that is a lot of cash. And it just made me so confused. I was like, this goes against my theory. My theory was that if you buy anything at the IPO, it would only go up. But what ended up happening, and what I didn't realize at the time, which I now understand, when a stock IPOs, there are private investors that have bought those companies' stocks before you. So there's private investors and then there's public market investors. Private investors, let's call it like Company A. Private investors get access to Company A stock before the IPO. So this can be angel investors, it can be venture investors, basically people that have access to this company before everyone else does. It can be through close proximity. It can be people that work at the company. It could be people in Silicon Valley. It can be friends and family that have invested. There's a range of ways that you can get access, but you have to be an accredited investor, which I was not at the time. I am now, wasn't back then. They all had ownership of the stock. I did not. When the stock went public, when someone like me, a retail investor, buys that public stock's shares, basically I am buying it from a private investor that is selling that exact same share. So the private investor is cashing out, selling their share, and I, the public investor, am buying it on the IPO day. So the private investors had made a lot of money because the share price went up. All the public market investors, myself included, bought those shares, but then there was no one else that wanted to buy those shares after us, and so the share price dropped quite significantly. This then happened again quite a few years later with other IPOs that we've seen, and we've spoken in the past on the podcast. Back in 2021, we covered Oatly's stock IPO. So Oatly is a oat milk company, and after their IPO, their share price has now dropped. In 2026, 97% Oatly is down since its IPO. So if you had bought $100 worth of Oatly stock, you would now have $3 left. And so in 2026, we're going to see a lot more IPOs happen. There's some really big ones that are coming up that I'm really excited about. But this mistake that I'd made had taught me that not every single IPO will result in a good outcome for the retail investor. And you have to be really, really careful. I'll do an episode another day on how to check if an IPO is worth investing into. Some will do really well, but some won't. And that was a expensive $200 lesson that I had to learn. Thankfully, I sold that stock pretty quickly. And the last I checked, it never recovered either. So it goes to show, sometimes you just have to cut your losses and move on. But I honestly did not expect it. And again, like I'm kind of channeling through my therapist, you take the things that happen to you and you learn your lessons from them and you move on. So that was my fourth investment mistake. Now, I could probably keep going, but the fifth investment mistake that I made in my first year of investing is I did not move my retirement fund provider for at least 5 or 6 years after I started investing. So I started investing in my retirement fund when I was 16, which is not because I was just like a 16-year-old investment protege. My parents took me to the bank and they were like, we need to set up a retirement account for her. At the time, the government in the country that I was living in gave every young person a free $1,000 if they set up a retirement account. My Indian parents were like, that's worth going to the bank for. That's worth turning up for. So we went, and I still remember the bank teller, or the investment advisor, and he said to me, we're going to set you up with this portfolio, which invests in, I still remember this, and he's like, we'll invest in growth funds and growth companies when you're young. And then as you get older, it will then switch to a balanced portfolio. And then the closer you are to retirement, it will switch to like a cash fund or a like conservative portfolio. I mean, that made sense at the time. And I don't know anything. And this was just like a man in a suit, and I was going to trust him. The issue then came when I realized that I just let the bank that I banked with, the bank that my parents banked with, I just let that be my default retirement provider. And I did not even question, like when I started like working, I worked at a petrol station, I worked at a Specsavers, like I worked at a different Specsavers after that. I did like a few jobs as a student, and not once did I think, because when you sign up to a new job, you like put down your retirement portfolio and who you're with. Not once did I think like, do I have to be with my bank? Is this the best? I just thought banks probably aren't going to like screw me over, so I should probably just stick with it. And I could not have been more wrong, because my bank and all large banks, when it comes to retirement accounts, whether it's your 401k, whether it's your ISA, whether it's your Super, your KiwiSaver, they all know that people that have their retirement funds with their banks do so because they've just not looked at other options and they've been too busy. And so banks are notorious for having high retirement account fees and not necessarily better returns for your retirement account. And so when I realized this, I was kind of annoyed at myself, and I moved over to a much more cheaper retirement account with higher returns. And I was mad at myself that I had like let this happen. And in the grand scheme of things, I figured it out early on in my life, but there are so many people that listen to the podcast that go, Sim, I've actually not taken that. It's like on my to-do list amongst obviously a million of other things I need to do, but I've just not taken out 30 minutes of my day to see who I am retiring with, what fund I am with, and if I'm getting a good deal. And no matter what country you live in, if you just type in your country's name and type in like retirement account comparison tool, there are so many online tools available now that will show you that, hey, who you're with might be actually cutting into your retirement account returns, because the fees are like 1% rather than 0.2% or 0.5%. God forbid it's like 1.5% or something absolutely outrageous. That is like daylight robbery. And if you are paying that, then you need to email me and I will send a very angry email to your fund provider on your behalf. But you realize over time that you can't be too mad at yourself for the investment mistakes that you've made in your past, because that was just part of your journey. No one taught us these things. Like, it's okay that I bought and sold all my Amazon stock. It's okay that I invested in a company or a fund that ended up being the highest performing fund, and that was the smallest amount of money that I'd invested. Like, it's okay that I did all these things, because that's part of growing and learning. And if you invest with good parameters around you and you understand your risk tolerance, then, as you can see, none of my mistakes was losing all of my investments. So none of my mistakes was like falling for a pyramid scheme or doing something really, really, really dumb. If you're scared to start investing, or if you're scared to invest more, just know that if you are listening to this podcast, you're probably actually smarter than you think, because you've probably picked up a number of tips and skills and stories, and you probably know more than you're giving yourself credit for. So with that, I'll end the podcast there. I hope you enjoyed it. If you can, please take a screenshot, put it on your Instagram story, tag friends that invest. It's the best way that we can get the podcast to grow, to reach more women that want to get better with their money, because what more can we ask for than a world where more of us are financially successful? And with that, I'll see you next week.